Welcome to The Explainer. Today, we're diving into a massive tug of war between growth and valuation happening right now with Mueller Water Products, ticker MWA. If you love digging into the hidden dynamics of the stock market, you are going to find this deep dive absolutely fascinating. We're talking about a $4 billion company that makes iron gate valves, fire hydrants, leak detection systems, basically the invisible infrastructure you walk past every single day. But behind the scenes of this 160-year-old legacy business is a valuation paradox that is literally dividing the smartest investors on Wall Street. Right off the bat, think about this massive 96.39% three-year total shareholder return. For a relatively boring company making metal valves, seeing nearly 100% return is just staggering. It really proves you don't need to be an AI tech darling to generate massive wealth. But here's the catch. That kind of explosive growth in a legacy industry immediately raises a red flag for value investors. You have to ask, is this stock price actually grounded in reality, or is it just riding a wave of unsustainable momentum? But before we get into the heavy lifting of the bull and bear cases, we've got to understand their foundation. Over 85% of Mueller's revenue is tied directly to U.S. and Canadian utilities. So why does this matter to us? Because it means this entire company is highly sensitive to government budgets, political priorities, and infrastructure funding. If municipal spending slows down even a little bit, their primary revenue engine could really start to sputter. So here is our game plan for today's explainer. We're covering the bear case, the bull case, the ultimate framework test, and finally, the final verdict. Let's get right to it. Section 1. The bear case. 7 hidden red flags. Let's look at the pressure points that should make any cautious investor pause. The stock is currently sitting around $26 to $27, right? But its conservative Graham number, which is a classic formula for calculating a stock's absolute maximum fair value, is just $11.60. That means MWA is trading at roughly 2.2 times its fair value. Out of over 2,000 industrial companies, Mueller ranks worse than half of them on this specific metric. If you're a defensive investor looking for a bargain, this extreme premium is a massive flashing warning sign. And this extreme price premium isn't happening in a vacuum either. Guru Focus flags the stock as 4 to 5% overvalued, and Wall Street is issuing pretty tepid hold ratings, with Barclays even targeting $25. But honestly, perhaps the most concerning part is what the people inside the building are doing. Over a recent 3-month window, insiders dumped $1.4 million in stock while only buying about $100,000 worth. When insiders are taking that many chips off the table, you really have to ask yourself why. Plus, making giant iron valves is, well, it's expensive. Their capital-intensive nature means they face a 27% production risk. That means a huge chunk of their operations is highly vulnerable to supply chain or manufacturing hiccups. And the company has openly acknowledged massive ongoing capital needs for foundry upgrades and modernization. Those kinds of expenditures could seriously strain their free cash flow, which is a really big deal when you remember they already have $449.5 million in debt sitting on the balance sheet. Section 2. The bull case. 7 powerful green flags. Okay, as impartial analysts, we got a counterpunch here. If there are so many red flags, why on earth is the stock up nearly 96%? Well, compare that insider selling against this staggering metric. A massive 95.82% of outstanding shares are held by institutional investors. That is some serious professional validation. Sure, a few insiders might be taking some profits, but the smart money, the hedge funds, mutual funds, and large institutions, they are heavily backing this company. In fact, 7 top investing gurus currently hold the stock. And why is the smart money all in? It all comes down to bottom-line profitability. The growth disparity here is wild. Over the last 5 years, Mueller's earnings per share grew at an astounding 20.8% compounded annual growth rate. The rest of the machinery industry, just 7.5%. They are absolutely crushing their peers when it comes to the bottom line. This exceptional earnings growth is without a doubt one of the absolute strongest signals of a high-quality business. And honestly, that growth shows zero signs of slowing down. Their operational momentum is practically surging right now. Guru Focus gives them a top-tier score of 91 to 95 out of 100, implying some of the highest outperformance potential out there. They just delivered the strongest quarter in company history for Q3, completely smashing consensus estimates by 28.2%. Even better, their EBITDA margin expanded by a massive 440 basis points. In management, they're so confident they've raised their full-year guidance for the 3rd consecutive quarter. Backing all this up is a seriously rock-solid balance sheet. Yes, they have debt, we know that, but they also boast $421 million in pure cash. Their Piotrowski F-score is a 7, indicating a very healthy financial situation. The Altman Z-score of 4.72 means bankruptcy risk is practically non-existent. But the real kicker you should take away from this is the Vanish M-score of negative 2.48. This is a forensic accounting metric that implies there is virtually zero risk of earnings manipulation here. These numbers are completely legit. Section 3. The ultimate framework test, testing high growth. So how would the legendary investors referee this incredible tug of war? We ran the stock through 4 distinct frameworks: the economic moat test, Benjamin Graham's value test, Peter Lynch's growth at a reasonable price test, and Warren Buffett's quality test. The results? Entirely split. It's a total dream for one style of investing and an absolute nightmare for another. Let's break down exactly why. Ben Graham, the father of value investing, he completely rejects it. The PE ratio is sitting around 20 and the price-to-book ratio is 3.74, both of which far exceed his strict limits. To Graham, you're vastly overpaying, plain and simple. But Peter Lynch, the legendary growth investor, he absolutely loves it. That incredible 20.8% earnings growth rate gives the stock a beautiful PEG ratio of 0.5 to 0.7. For Lynch, finding a company where the price tag is lower than its growth rate is literally the holy grail. Then you have Warren Buffett, who'd probably just toss this right on his watch list. The metrics are so painfully close to his ideal business. The 15% return on invested capital is great. It meets his threshold perfectly. But that 39.4% gross margin? It falls just a fraction short of his strict 40% rule for a wonderful business. Plus, while Mueller has a deep 160-year history, their moat is considered narrow. That's simply because they lack true pricing power due to that massive reliance on municipal budgets we talked about earlier. Finally, Section 4, the final verdict: trading a paradox. Let's bring it all together. How do you actually trade a paradox like this? At $26 to $27 a share, you are undoubtedly paying a premium for a high-quality water infrastructure leader. As Buffett famously said, price is what you pay, value is what you get. If you're a strict value investor, you might want to hold out for a pullback to the $24 or $25 range, just to get a better margin of safety. But if you're an operational momentum investor, those record margins and raised guidance might be all the convincing you need. You really have to weigh the exceptional execution against the lack of a traditional margin of safety. Ultimately, it all boils down to this one absolutely critical question you have to answer before investing. Can Mueller Water Products sustain this exceptional 20.8% EPS growth? Can they outrun the cyclical pressures of municipal budgets and those heavy foundry upgrade costs? Or is this 160-year-old iron giant finally flying a little too close to the sun? Think about it and let me know which side of the paradox you lean towards. Thanks for joining this explainer, and keep questioning the data.